Good afternoon, everybody, and welcome to the Thursday afternoon Independent Solutions Investment Committee call. I'm Glenn Wiggle. On today's call, we will have Mike Lomas again moderating the call. We've got CFA John Thur will be joining us. We've got Paul Meeks, also CFA. Danny Neiman, who's our Chief Investment Officer and Mutual Fund Manager, is also joining us as well. Finally, we have Mike Zimmer. So I think I've got everybody. We'll have about a 15 to 20-minute call today, and obviously, if additional questions, of course, go to our website at iswealthmanagement.com. Mike, you have the floor.
So we'll start off with you, Paul Meeks. The next 45 days may just become the most critical in U.S. history, I think, specifically the execution of the awakening of this economy. And I wanted to get your thoughts on how you sort of see that playing out.
Boy, that's the $64,000 question. What I'm really focused on is, of course, I'm interested in the timing and the staging, right? Because we don't necessarily switch and so quickly get back to 100% capacity on an economy that is slowed down and then shut down in stages, state by state, country by country, industry by industry. I'm very interested, and we're now starting to get some early glimmers of information on coming out from companies that obviously are impacted by all this stuff that you're referring to. And particularly, I'm listening to all the quarterly conference calls from my tech companies. They're now, just over the last couple of days, coming fast and furious, and see what they have to say. Not about the March quarter, that's in the past, not really even about the June quarter, because everybody's got a grasp on that. But what happens for the rest of 2020? And my preference is for companies to lower their earnings forecasts all the way to the floor. And I prefer that my companies actually don't give guidance for the rest of 2020, just kind of throw in the towel, kitchen sink it. And then when that happens, we can't go down any lower. And when that happens, we actually can have positive earnings revisions instead of negative earning revisions. And that's how I think we build a bull leg in this market that is more than a leg, actually is a durable and longer lasting bull market again. So that's what I'm looking for. It's going to be very interesting to see how it plays out. We obviously have a battle royale between our president and various governors. It'll be very, very interesting. And you're absolutely right. The next couple of weeks or months, super, super, super critical.
Yeah, thank you. Well, Mr. Thur, we'll switch to you. John Thur, a chartered financial analyst. The U.S. economy has basically erased nearly all the jobs gains since the financial crisis of 08 and 09. When do you think we start? It's funny, not funny. I mean, the jobs numbers were awful this morning, yet the Dow was up a little bit. I mean, when do you think we start to focus back on some of those numbers? And how much does that really mean right now?
Hi, Mike, and hi, everybody on the call. Thanks for joining us. That's a good focus point, Mike, and I think the market is overlooking the current data. A lot of the economic data, a lot of even some of the corporate data, because they think this is going to be short-lived, and that once the economy opens up, that we'll be on track again, and we will recover relatively quickly. So they're just looking right over the top of this and saying, they're laying off today, but 3 months from now, they'll be back to work. I think we need to start to see come out of the recovery. Come out of the, everybody staying home, and once we get going, I think they're going to realize this is going to come back a lot slower than they think. I don't know how they can just turn it on and everybody goes back to work. We don't have any testing yet that everybody can be susceptible to. We don't know who's had it, who might have had it, who has antibodies for it. And I think until we get some answers, I think it's going to be hard to really open things up. And I don't know when that's coming. So I'm watching to see how we're doing on the testing. And beyond that, the other issue is some form of a vaccine, which I don't think we're going to get until the fall. For some people to feel comfortable knowing that if they do get it, there is something, or if they can get a vaccine to prevent them, a high probability to prevent them from, getting severe case of it, I think we're not going to feel comfortable, in social settings. So I think it'll take a little bit longer. What I'm looking for in the earnings calls is conversations from CEOs to talk about dividend. Are you going to maintain your dividend? Are you going to increase your dividend? Or are you going to cut your dividend? And then I want to hear about, and I think the companies that are going to increase their dividend, they're going to get bought. There's going to be a lot of buying going on in those companies. And the companies that are going to cut their dividends, there's going to be a lot of selling going on in those companies. And then we're going to look at CapEx. Are you going to cut your CapEx spending? And layoffs. Are you planning layoffs? And how much? And that's going to give us a flavor for how CEOs are looking at what the damage could be and for how long. And that'll give me a better flavor for the top, leaders in this country and what their decisions are going to be. And that'll give, I think, the market a little more focus on, which direction to go into and how to value investments. Finally, I'm looking at bonds. We haven't gotten into the downgrades, nor have we gotten into the defaults yet. Those are coming. And I want to see how bad those are, and we kind of know what sectors, but I want to see how prolific they are and how we deal with those. You saw J.P. Morgan come out with earnings the other day, and they put up a huge reserve for their non-paying loans. And I know why they did it. They did it because the market's pounding their stock right now, so they figure, let's get all the bad news out right now. And after they got the news out, the stock went up. So what they've done is padded their balance sheet with these reserves, take the hit now so it doesn't affect their stock price anymore. And then in the future, if all those defaults don't come to fruition, they can add it back in their income, which makes them look good.
Yep. John, it's funny because we've always preached diversification, and we also preach about not trying to totally time the market, but make, subtle adjustments. And it's funny because you just said a bunch of what would appear to be top-level negative stuff, but then that negative stuff comes out, and sometimes it drives a stock or a bond forward, right? So really key to sort of be patient and not make wholesale crazy changes here, right?
Yep, exactly. And it's all about price versus future return. And it's that simple. Things could look their worst, and that's when I'm in buying. Because the stocks are getting beat up way beyond where they should be, and there's going to be value there over the next couple of years for the long term.
Yeah. Perfect. Mr. Neiman, Dan Neiman, you are in charge of, a lot of our overall models. And I wanted to ask you about, our diversified portfolios. John talked about bonds, and, it seems to me, just looking at some of our balanced models, that, that they're holding up a lot better than, the overall market itself. And I just wanted to see if you could comment a little bit on, why that is, and, what types of moves you're doing, and how, for clients or financial planners that are on this call, how should they be looking at that to position their clients for the next quarter or two going forward?
We're watching, obviously we're watching what the market's doing. I agree with Paul and his statements where we need to see a bottom established. We saw a bottom, the market, kind of went up from there. Now about a month ago, I feel like it was, 3.5, 4 weeks ago, we saw a bottom. I still think with what John and Paul talked about, we still don't know a lot of things, and that's going to potentially lead to, more down than up. And I think we need to, see those lows tested before we really can dive into being more invested. From a portfolio management standpoint on the allocation models, I think, we did a rebalance in January. We did another one in March. If we need to do another one in May, we can, but likely we are good where we are. I think we took the profits in January, we invested some of those profits in equities in March, and I think our portfolios are kind of doing what they should be doing, relative to what the markets are doing. I do think, like John mentioned, that, testing needs to come out. I know here in San Diego, there's a couple places now where you can get antibody testing and you can get COVID-19 tested. If you actively have it. So you can get the antibody test if you think you may have had it. I don't know what that solves in the current situation. We're obviously still on a stay-at-home quarantine, right? Across most states, across most places, businesses are still closed. But I do think that that's a step in the right direction. So in a couple weeks, whether it be end of April, mid-May, we can start to slowly roll back into some sort of normalcy or some sort of, uplift of the economy. Then that will allow people that have to go out and do their jobs to get tested, or people that maybe feel like they did have it back in January or February to go see if they have the antibodies for it. I think it's going to be a lot longer term before we find a vaccine for this. I think it's more next year, but there's really so much uncertainty that we really have to just sit and wait and watch and be patient when it comes to whether it be investing cash we have on the sidelines or shuffling the deck when it comes to our portfolios at this time.
Real quickly, it does seem like our balanced models and our conservative models have been holding up. And is that mainly because the portfolios, and I guess looking forward, is that the bonds that are holding that up? And if so, what bonds in the portfolios are you buying? I mean, is there a shorter term, long term?
Well, I think that, the move to more short term by the fund managers that we hold has helped keep the bond, the fixed income side of our portfolios more steady. But bonds were hurt as well. It wasn't just stocks that were hurt over the month of March. Bonds were hurt just as much, if not more, in some areas. That flight to safety to bonds wasn't there. So I think the overall portfolio, the positions we have in our strategic allocation models, in the mutual funds, the mutual fund managers are doing their job and their part inside of each asset class. Inside the ETF models we have, I think that the portfolio allocation is set in such a way that we have the ability to protect on the downside and to mitigate some risk because we aren't as heavily weighted into some of the more risky asset categories like long-term bonds or heavily weighted into, say, growth or international, which can be hurt more in down markets.
Perfect. Thanks, Dan. Paul, let's switch back to you. Yesterday on CNBC, you were talking about, you've been spending a lot of time upgrading from the JV team to the varsity team. And, you're known as a tech manager, although you help us out with a lot of different things. But, today, once again, it seemed like tech sort of led the rally. And I just sort of hoping you could comment on explaining that. What is upgrading from the JV team to the varsity team? And then why is it that tech seemed to be, holding their own here?
Well, the second part first, I think that we already had established a move from the analog to the digital worlds, well before the coronavirus, right? Somebody like Amazon had come in years ago and decimated traditional big box retail. But I think what's happening with the coronavirus is that transition is accelerated. And, I don't always talk my tech book or my tech sector. Remember, last year I was actually telling people not to invest in the sector or not to invest with me. But I'm actually seeing through the coronavirus that this is playing right into our hands with this acceleration in the transition from analog to digital. And so what I'm doing is I'm getting more comfortable being tech. And it's kind of interesting to me that tech stocks are perceived as being super volatile, and they are. But you would think they would be super volatile on the downside. But actually, the tech sector hasn't been the best sector of the 11 throughout the coronavirus, but it's been pretty close to the top. It's actually been a place that you would think is very weird to be relatively defensive when it's known to be so volatile. But I think it's because more and more folks are throwing in the towel and saying that it's important that you're in some of these digital beneficiaries and out of the traditional cyclical analog companies. Mm-hmm. So even within technology, I'm trying to figure out, hey, is this company really going to be best positioned among technology stocks on the other side? And I've concluded that no. I had a couple of them that as tech stocks got super expensive in 19, that I kind of went for values instead of quality. And now I'm comfortable getting rid of those JV players and going into the varsity players because for the first time in a lot of years, I'm more comfortable with the valuation as they came down, at least 20 to 30% from the top before they rebounded. And so I'll continue to upgrade the technology portfolio, but I'm feeling better about the technology sector than I had. Not necessarily because it's cheap, it's not, but because I think it's the biggest and best beneficiary of the move from the analog to the digital world.
That's funny because you sound optimistic as a portfolio manager. Yet yesterday on CNBC, you said, well, I'm still holding some cash, right?
Yeah, I do have some cash. Yeah, so what I've done is I've sold the JV team, and if there were some varsity guys that I was interested in that going to be beneficiaries on the other side, I would invest in them. But if I don't find something, I just keep it in cash. And right now, even in my mutual fund, I have 6% cash, which is quite high for me.
Yeah, perfect. Mr. Mariacher, I think you're on the phone with us now. The stock market has sort of been sideways over the last few days. And, you going back a year ago, you said Trump's second term, you saw Dow 30,000. And I guess, sort of talk a little bit about what you see with the market trending sideways here over the last few days. What does that mean to you? And then, are you still a long, bullish believer that we're going to hit those numbers?
Yeah, Mike, thank you for all of our listeners tuning in. And hello to everybody. Yeah, I had been a proponent of Trump and was on his bandwagon since he had announced. And I did predict his victory. I predicted Dow 30,000 in his second term, the second year of his second term. I'm sticking with that. He's been in quite a wrestling match. And you could probably throw jiu-jitsu in there too and kickboxing as well. I think he's coming through this, and I think that I'm going to stick with that. I've talked about Microsoft for quite some time. I've talked about the Blackstone Group for over 5 years, Mike. And the Blackstone Group is kind of a lagging indicator, and they've held up very well. And their dividend is good. And Microsoft to me is the leading indicator. And I've really allowed Microsoft. It really worked hard at making a market bottom a few weeks ago, and I have followed that right through. And have been buying right through this mess. And I'm ecstatic about it. And I continue, like Paul says, looking for value, poring over balance sheets, things like that. So I'm pretty excited about where we were. I'm more excited about where we are now because I get, like everybody says, I'm buying stock with better valuations at this point, and I'm sticking to the good balance sheets.
Perfect. Thanks. Let's switch to John Thur here. John, you've not only an equity stock portfolio manager, but done a lot of work in the bond sector and managed money for trusts and banks and all that. One of the questions I was asked by a client the other day was, should I be worried about buying New York state tax-free bonds? And, I think the fear is that, a state like New York is just accumulating so much debt, already in debt prior to the coronavirus, now adding on who knows how much without, any revenue coming in. Is that something that would concern you long term? And if so, what should an investor be prepping their portfolio with if that's not an option for them?
Mike, the easy answer to that is you are correct. You should be wary, but it's not just New York State; it's all states. There are certain municipals that you can buy pretty regularly, and there's certain states you might want to stay away from most municipals, like Illinois. Very tough state, and you got to be careful. So the simple answer is yes, you have to pick and choose your spots, but there are a lot of opportunities out there. I was just on a conference call with J.P. Morgan's fixed income group yesterday, speaking specifically about the municipal market, and it is still somewhat cheap relative to U.S. Treasuries, which means the yields on the municipals are higher than the yield on U.S. Treasuries, which is highly unusual, but Treasury yields being where they are is highly unusual, which also makes this very difficult. And where I am at with this is I look at the banks, and the banks will not lower, most of the banks can't lower their interest rates any lower, even though the Fed went to zero. Bank rates for mortgages even went up, but mortgages, car loans, they can't go much lower because they cannot make money going any lower. So we're at a point where we're at a floor. So I think the bond market has to get to that similar point where managers step up and say, that doesn't work for me. For the risk I'm taking, even though those yields are way beyond where they should be relative to treasuries, they're still not good enough for me. So like I said, I want to wait for not only the corporate market, but the muni market to start talking again about, pension liability in these states, how much it costs them to fight the virus, what kind of fiscal, situation are they in on budgets and, credit ratings, and then be able to make better decisions. So right now the yields are not attractive on a broad basis, but selectively here and there, yes, you can pick up some really nice bonds.
And but should I be worried about them? I mean, do you see defaults in the future, or is that, I've been saying I think this problem actually is going to sort of rear its ugly head 20 years from now, not a year from now, because I think we're just looking at so much money flowing into this from the federal government in the short term. But to me, the real answer to the question is, well, who's going to pay for all this, right? And does that get kicked down the road 20 years from now? Is that something I would worry about short term or long term?
I would be concerned. If you own, a junk bond portfolio or a mutual fund, if you own a, junk bond or low investment grade municipal portfolio, that's not really where you want to be right now, because the durations are longer and the credit risk is higher, and I don't think you're getting paid for it right now. I do think there will be, even though the Fed is in supporting the market by buying bonds, I don't think they're going to buy the worst bonds and eat them. So I don't think they're get in the way of bankruptcies or defaults or restructurings, but they will be there to support for a liquidity purpose, because there was huge amounts of sales. What you have to understand is, under the new law after 2008, they restricted investment companies from holding, unlimited amounts of inventory. They said you can only hold X amount of dollars of inventory. So each trading desk only had the capacity to take on so much. When the sales started coming in, the trading floors got filled in the first 5 minutes. They couldn't take any more, but the selling still came in. And that's what drove prices down so low. That's when the reserve had to come in and add liquidity to the market and be a buyer, because they were not letting the banks do it, and the investment banks. So that's exactly what went on, and that's what their job was, to come in and be that buyer. And that's where a lot of this money came from, was from the government to take the other side of these trades, and that's what stabilized things. But it can't prevent defaults or credit downgrades and those kinds of things. So we have to wait and see how that plays out. It's still to come.
So, sounds like Paul's theme of trading up from the JV team to the varsity team doesn't only apply to tech stocks. It might apply to everything right now.
It does, because when the new money comes back in, it's going to go to the more quality stuff first, get their toe in the water. And then when that gets fully priced, it'll reach out, and as time moves on and some more answers are developed, you're going to get more comfortable taking a little more risk. And then as we get more into the upcycle, then you step out and you go to that next wave and maybe take a higher level of risk. And that's how things progress in the market and with managers.
Perfect. Just a few more calls. We'll keep you in line for a second. Dan, real quickly, you're a stock manager as well, and, you're looking at dividend stocks, and there's been a lot of talk about dividends being cut. Are you seeing that? I mean, prices went down and the dividend yields went way up, and everybody said, wow, look at these yields, they're amazing. But are you seeing any of them, getting lowered right now? Is that something you would be concerned about?
Not yet. Not yet have we seen companies come out with lowering their dividends. I know one company we follow, Costco, raised their dividend 7%, but of course they're probably the diamond in the rough when it comes to the pandemic, where people are lining up for their toilet paper still to this day. I think there's going to be cuts, not necessarily across the board, but I think that we'll find out here as earnings come out, as companies do their annual meetings and give guidance that we talked about earlier in the call, like Paul mentioned and John mentioned. And we need to, be diligent in keeping track of what companies are reducing their dividend or saying they're going to hold dividends, and make sure that those companies are not in our dividend portfolios any longer. So while we may get hurt by some of those companies, I think that's one of the things that I'm watching for, making sure that I'm in companies that have low debt, lots of cash on the books, and when they come out with their guidances for the next few quarters or for the year, that they don't say they're cutting their dividend or stopping their dividend altogether.
Right. Perfect. Mr. Meeks, should we be focused 100% on the U.S.? I mean, it does see, and it's funny, you hear all this, to me, some positive news in China that they're back on track. I don't know how true that is. You never know what to believe out of China, but, it seems to me that their economy is starting to heat back up again. And, but I don't see a lot of focus internationally from an investment standpoint. It seems to me that everybody is focused on, the U.S. And the U.S. path to recovery? And, should we be focused on other, international markets?
I do think that we should focus globally. Even before we headed into the coronavirus, the U.S. was only about 25% of the world's GDP. And so you can't disregard the other 75%, though I would think that Europe is going to be in a deeper funk, longer lasting funk. I do know that China isn't back to 100% capacity, but they're getting there, maybe at about 60% at this point. And I know that because through following U.S. tech companies, I follow their Chinese supply chain partners. And then the other thing that impacts me, but I think it'll also impact a broader swath of investors, is in technology, in communications. We still are, maybe a bit delayed, going to have a massive rollout to 5G wireless. And when that happens, that is a global play, and it's a real big play. And so I watch that pretty carefully. But that's not only going to impact tech companies if they get it right or wrong, but it's going to impact the whole communications chain, which goes well beyond tech, and it could be a major driver or a major disappointment if it doesn't work out under the timeline originally conceived. And so I'm looking at those things. But yes, I would definitely look at Chinese companies. I look at companies like Alibaba, which is essentially the Amazon of China, maybe even a better position than Amazon. But I'm really straying away from European companies. I think they're going to be in a world of hurt.
Perfect. Final question, Mr. Mariacher, joined us a little bit late, but I want to just sneak in one more question. Healthcare stocks like Abbott Labs have been rising as they've been searching and testing for solutions to this virus. Are those buys right now? Is that something you're looking at, or do you think it's just a short-term upswing and something to sell?
I think the biotech and the old pharma are always something interesting to look at. I've been a long-term holder of Abbott Labs. It did spin off AbbVie. It's been a great company. There's several other companies that I watch, but I did not buy them. I'm an owner of Pfizer, and I love the dividend. You spoke about it as well. Spoke about some kind of working on the virus, but Abbott did make an announcement. It was about a week and a half ago about some kind of a testing apparatus and or way to test, and it was supposed to be shipping, and the stock did move on that. There was another company by the name of Moderna that was in there, and that stock has doubled. Although I didn't buy it, I thought it was speculative. But there's been a lot of heat around that area. But I do like pharma and have for a long time. They are not big holdings of mine. I'm more technology and companies like Walmart and Procter & Gamble as well.
One final question, Paul. When you were on CNBC yesterday, you were talking about some of the short-term plays, and there's been a lot of information and a lot of hype out there about stocks like Zoom, right? We're all doing these teleconferences, and I just want to get your thoughts on that. Is that something that investors should look at inside their portfolios? I know some of our managers. I mean, you're one of them, and you own it. Is that a theme that you think is going to last for 20 years, or is that something that you think is going to be a short-term type of rally?
Now, I think video conferencing and more remote work from home is clearly a theme. I think that Zoom is just a trade. I mean, I own it very cautiously. It has an egregious valuation. They went very quickly from 10 million subscribers to 200 million, but I'm not clear as to how they're going to monetize any of them because they give it away for free. And at the end of the day, one of the behemoths like Microsoft with their Teams or Microsoft with Skype could at one point just say, you know what, we're going to bundle that just like we did with our browser in the 1990s to take out Netscape, and we're just going to give it away for free. And then Zoom would be in trouble. So the way I look at it is, yes, there are some stay-at-home stocks that are attractive, But as soon as we get better news flow on the coronavirus, they are out of my portfolio as fast as they came in because they're not long-term quality.
Right, perfect. All right, well, I appreciate everybody joining us today, all of our portfolio managers. We're going to do this, folks, every Thursday until some of this volatility goes away. Week in and week out, we're going to be here. If you have, or if you need more information about our services, our departments, you can always call us at 833-SPIN-GUYS. For financial advisors seeking additional information on independent solutions, wealth management, model portfolios, performance data, and our private wealth group, you can always go to iswealthmanagement.com, iswealthmanagement.com, or give us a call at 716-568-8566. Okay, everybody, we will see you next Thursday, same time, same place, and we will send out email confirmations. So hopefully we'll see you next Thursday. Take care, stay healthy, and be safe.